Roth IRA accounts are highly desirable retirement accounts. They allow for tax-free growth, they allow for tax-free withdrawals, and they are not subject to required minimum distributions. Unfortunately, the IRS places strict income limits on your ability to contribute to a Roth IRA account. Fortunately, there is a solution to this problem: the Backdoor Roth IRA. I'm Aaron Skloff with Skloff Financial Group, and in this video, we're going to walk through the 5 steps to complete a Backdoor Roth IRA account. What is a Backdoor Roth IRA? A Backdoor Roth IRA is a legal tax strategy that allows high-income earners to contribute to a Roth IRA even when their income exceeds the IRS limits. Instead of contributing directly, you make a non-deductible contribution to a traditional IRA and then convert it to a Roth IRA, a perfectly legal 2-step process. For 2026, the Roth IRA income limits are based on your filing status. If you're a single filer, you phase out in your ability to contribute to a Roth IRA account from $153,000 to $168,000. Throughout that window, you start losing the ability to make your full Roth IRA contribution. And after that window, you cannot make a direct contribution to a Roth IRA account. For married filers filing jointly, the phase out is between $242,000 and $252,000. The annual contribution limits to the Roth IRA account is $7,500 for those under the age of 50 and $8,600 for those ages 50 and over. There are 5 key benefits to a Roth IRA. Number 1, tax-free growth on your investments. Number 2, there are no required minimum distributions. Number 3, tax-free growth on the withdrawals from those investments. Number 4, there are no income limits with the Backdoor Roth. Number 5, it builds long-term tax diversification. The Backdoor Roth IRA, 5-step process. Number 1, open a Roth IRA account. Number 2, open a traditional IRA account and contribute to that traditional IRA account on a non-deductible basis. Do not deduct on your income taxes the contribution that you've made. Number 3, keep funds in cash or the money market account. Step number 4, convert that traditional IRA to a Roth IRA. Number 5, report IRS Form 8606. Reporting on Form 8606 lets the IRS know that you've already paid taxes on that non-deductible contribution, and that way you avoid double taxation on the conversion. Watch out for the Pro-Rata Rule. This can get a little bit complicated, but I'm going to make it really easy. What is the Pro-Rata Rule? If you have other pre-tax money in a traditional IRA, a SEP IRA, or a simple IRA, the IRS requires you to calculate taxes on your conversion proportionately. You cannot cherry pick which dollars are converted. This can create an unexpected tax bill. How to avoid it? Roll the existing pre-tax IRA into your employer 401k or 403b before converting. Keep the backdoor IRA separate to ensure a zero balance in all traditional IRAs by year end. Complete the conversion in the same year as the contribution. There are some key reminders. Do not deduct your traditional IRA contribution on your tax return. Remember to file Form 8606 every year you do a backdoor conversion. There is no waiting period between contributing and converting. You can do this every year. It resets annually. And consider working with a tax professional, such as a CPA, for this strategy. So let's recap. If you have a higher level of income, you may not be able to contribute to a Roth IRA account, but the Backdoor Roth IRA is the solution. There's 5 steps. Let's go over those again. Number 1, open a Roth IRA account. Number 2, open a traditional IRA account and make your contribution after tax. Number 3, keep the funds in cash. Number 4, convert the traditional IRA to a Roth IRA. And number 5, don't forget to file your Form 8606. You don't want to pay double taxes when you convert and make future withdrawals from that Roth IRA account. If you're interested in learning more, go to skloff.com. That's skloff.com and click the contact button. Thank you.